All right. Welcome, everybody, to our May webinar, Death of Retail Again. We are Holmquist and Gardner, PLLC, a group of experienced attorneys working in real estate and business law, founded in 2008 by myself and Hamilton Gardner. We are excited to have these webinars and give you guys some information about what's happening in the world on a variety of topics and kind of take it outside the normal, whatever continuing education you have to do for your professional licensing or day-to-day work, and certainly our day-to-day advice. With that, just a quick note before we get into our speaker that this is for informational purposes. As always, you should consult with an attorney independently on any matters. This is for informational purposes only and does not constitute legal advice. So today we are extremely excited to have with us Sean Tufts, who has had the great pleasure of knowing since high school. Good old days at Garfield High School. You'll notice maybe that our logo is purple. Go Bulldogs. And Sean and I have had the great pleasure of working on a number of transactions together. Sean's had a long career in commercial real estate, focusing in the sale and acquisition of retail properties. His company that he has a leadership role, a management role at, is Capital Pacific. That brokerage has offices in Oregon, and he brought them into Seattle and has been doing this since about 2003. Sean's integrity and knowledge in this specific part of the space is unparalleled, and we're excited to get into kind of where we're at in the world today. Sean, thanks for joining us.
Thanks for having me.
So before we get into sort of the meat, why don't you kind of give us an update on where we're at today? Are we dead in the retail segment, or what?
I think mostly, everybody just loves a good headline. So it's an easy one. People throw it out. We hear it every couple years across the country that retail is dying or dead or, is resurrected or whatnot. I think, the biggest takeaway, I think, for all of us in the last 12 months has been, when you lock everybody down, everybody realizes they don't want to be locked down, and people would rather be, in a grocery store and or a restaurant or out spending money. So no, once again, I think, the media and the headlines overblown. Sure, there's been a lot of pain, mostly from mom and pops. A lot of restaurants and, stores downtown have been a struggle through the last year. But I think overall, retail has jumped up, I think 56% in overall sales volume from just retail spending in the last 12 months from last April. So a lot of pent up demand, a lot of folks that want to get out of their house and get away from their home office and start spending some money again.
Yeah, and I think, as we talked about, you and I yesterday, there's this definite vibe about going out and doing actual shopping at retail locations, going to dinner, things that we kind of took for granted. And there's definitely a heightened excitement that I think we're all feeling about that on a day-to-day basis. So as we move through this, I forgot to note, if you're sitting there staring at your computer screen or your iPhone or whatever, feel free to take notes. We'll do some Q&A at the end, and happy to answer questions as we wrap up at the end of this. With that, Sean, why don't you take us through where the herd is going and what kind of mentality we're seeing out there in the marketplace in the retail investment space?
Sure. Yeah. And before we kind of dip into the, stats and graphs and all that I think everybody likes, I mean, the bigger picture is just, what's been happening. We sell shopping centers, single tenant retail properties kind of throughout the Northwest is our main focus. We do a little office and industrial, but the focus has been on kind of retail for the last, 20 years in our business. We don't do any leasing, so it's just strictly from a sales and an acquisition standpoint. Every time there's a glitch or there's a change, people look to Wall Street, they look to what the REITs are doing. This was a very unique change in the last, 14 months since COVID really impacted things. It absolutely put, the REITs on pause. Their stock dropped tremendously, and, there was zero acquisitions from that standpoint. I think a lot of, private equity and others followed suit in that. Some of it was just, feeling out, where's this thing going? What is the landscape? What do rent rolls look like? How bad's AR going to get? What tenants are going to survive and not? That was primarily true. We had a couple months of pause, but then things did start to break loose. The 1031 deadline that everybody lives under was extended last summer, but then it wasn't continued to extend it. So forced some transactions, primarily, on the single tenant side of things, where the herd kind of went to, was just flight to safety, flight to quality, flight to credit, and I think it would shock everybody looking back that we would have seen, cap rates actually drop for retail properties. The bad stuff is bad and didn't trade, but the good stuff is good and was, even better from a performance standpoint if you were trying to sell something.
Yeah, it was interesting to see towards the end of last year, and here you mentioned that we didn't really have deals that just fell through. I mean, people kept going that were going to go on 1031 issues and other matters. It wasn't like, okay, we're done. They kept the deal going and we got stuff closed and it all worked out. So again, kind of contrary to whatever the media was saying. I think here we go, a cool slide on this.
Yeah, I'm not the prettiest of graphs, but it's interesting to note. I mean, we had a massive 2019 here in the Northwest, primarily in Washington, driven by the excise tax changes. So we saw volumes kind of jump through the roof as people were getting through the excise tax, trying to beat that deadline. A couple of big portfolios of transactions went by. But then last year, I mean, everybody would have expected that to tick down tremendously. And in the single tenant space, again, which I think people view as less risky, although we'll talk about that later on, it still had a very solid volume up over 2018, which I think would have surprised everybody. And again, cap rates, that I think most folks would have predicted would have risen, kind of held flat. And again, that's probably just a testament to the deals that did trade were of the higher quality stuff, better credit, longer term, better real estate overall. Can't, on the next slide, can't be said the same for, unanchored retail centers. They did take a bit of a hit. If we can flip through, Mike, to the next one. Down from that obviously massive peak in 2019, but off, by 50-60% from the 2017 or even 2015 to 2018 kind of average. This year we are starting to see that pick back up quite a bit. As a company, we just actually had our best first quarter in 22 years. Which I think surprised most folks, both in kind of deal volume and number of transactions. So a lot of pent up demand, a lot of folks that had waited. Not a lot of those were properties that would have transacted last year and got kicked. It was more fast folks trying to come in, take advantage of low interest rates, and then realizing overall that the tenants that had survived to this point are going to make it. Say what you will about government interjection, but the PPP money, eviction moratoriums, the lessons I think landlords and lenders learned from the last Great Recession, I think did a tremendous amount to get us to where we are today, which is quite a bit of optimism. Yes, there was some fallout, but a lot of that fallout were probably tenants that wouldn't have survived over a long period of time anyways.
Yeah, it certainly, I would say, feels like there was a lot of question marks starting March when all this came down through the end of the year. And it feels like now people feel like the questions have been answered. We know where this is going and things are a little more predictable. I mean, that is stating the obvious, but it's important to look back and go, wow, we had no idea it was going to happen. And there was a lot of sky was falling type mentality, and we know it's not, and it's fine. So that is somewhat comforting.
Yeah, it was scary times going into that. A lot of questions. I mean, we had, conference call after conference call or Zoom after Zoom of, what are we going to do? What should we do here? I'm sure you did from a legal standpoint as well, but, that memory of, kicking tenants out and how hard it is to replace and expensive it is, the downtime to fill vacancies really, stuck with folks. And we just saw tremendous, help from all sides to try to get these tenants, especially on the mom and pop side, to hunker down and keep in business and keep the lights on.
Absolutely.
The next, on the next slide, Mike, is what did take a massive hit was that grocery and power anchored space, power center space. The most of this product is controlled either by REITs or institutions or private equity firms or just long-term generational families. And, if you don't have to do something, don't. REITs just frankly couldn't sell. Private families, were not levered like they were, 10 or 12 years ago during the last downturn. And, essentially nothing nothing happened last year. That has, kicked into gear a little bit now at the start of 2021. And our BOV volume is probably, is up and exceeding where we were this time in 2019 even. So we fully expect more product to hit the market, and prices to maintain and hold pretty strong.
This stat doesn't shock me, really at all. There just wasn't a lot of movement or reason to move. To your point, what's the obvious next move here? Well, let's do nothing. Let's see how these questions get answered. That's kind of how battleships work. They don't turn that fast. And so a little stagnancy here, I think, was to be expected.
Yep.
All right, Mike, next slide. Beneath the obvious here.
Yeah, we, always try to look kind of, looking back in the rearview mirror. The Northwest actually held up fairly strong, even though we had probably the most restrictive lockdowns in the country. Rent collections here on the retail standpoint we're in the 5 to 15% better than the rest of the country. Speaks to just the the stability of our marketplace. The lack of kind of bad retail up here. As you see, overall deal volume was down tremendously, but definitely picked back up and recovered a lot of that in the fourth quarter. Now the biggest takeaway I think everybody's you're hearing about timber and lumber, but it's the rest of the construction costs as well that are going to be the biggest impediment to new development and new construction. There's I can't think of a single traditional shopping center that's under construction. The only deals that are in the works are, driven by national credit tenants, and those are single tenant, properties. A lot of the supply in retail that we've seen has been that, ground level forced by the city because they want, everything to be 5 stories with a cute coffee shop at the bottom of it. Hopefully there's a lesson that comes out of this and to the city planners that's not always the best case. Bad retail is bad retail. And when you force it in as an afterthought, you just don't have an experience. You got bad layouts, you have bad kitchen access, you have smell issues, all those things that don't make for, a pleasurable experience.
Well, we didn't talk about that in getting prepared for this, but that is a huge point that we're seeing right now in the city of Seattle. Just generally. So it'll be interesting to see how that goes and how and whether the powers that be make a shift towards the more reasonable on that front. I think we know from past experience that's unlikely, but hey, if you're listening, city of Seattle, that's one area where we could also use some focus.
And the difference this time around might just be that, those deals are boarded up now and they're going to stay boarded up, and no city wants to see that, right? Where, 5 or 10 years ago, those would just sit vacant with, a picture over the wall. But when it's a piece of plywood, it's hanging around for 3 years, it's maybe a little different impact going forward.
Yeah, absolutely. Absolutely. And, one of the things we talked about yesterday is kind of interesting coming out of sort of things that are sort of beneath the obvious, a shift in market terms and leases. Now that we've seen more or less what's going to happen when you have a government shutdown impact a lease, and then all the tenants scurry to get their nationwide tenant letters out requesting deferments. What have you seen in terms of shifts in lease terms surrounding force majeure, and kind of how the sharing and burden shifting of risk for a government shutdown might play out in a lease?
Yeah, I mean, with every good crisis comes, the first to react and the first to overreact. It was, I think, the first company that went hard at it nationwide. No surprise is Starbucks, who, likes to think they're the biggest, baddest gorilla in the room. Sent a letter to every one of their landlords saying, cut our rent or we're not going to pay. Most folks, I think, took that to do some digging into the store financials and the performance. And I think that's where we're going to kind of shake out here is, yes, there will be force majeure language inserted into it. It was, egregious this time last year for new deals and or renewals. It's settled down, and I think we'll find a happy medium of something that actually works. But, for landlords, critically important to have those performance metrics in there, have the ability to see how this actual unit is performing. It's easy to say that, Starbucks, yeah, you can't go into the store and buy things and sit there. But most of those people were just using the Wi-Fi anyways, and now they're just going through the drive-through. And Starbucks came out the other end, with bells on. So had a phenomenal year overall.
Yeah, I think that it's been interesting to watch what happens with these terms that become kind of baked as commercially reasonable. And I'd say going into last year, you'd want to see financial reporting language in these leases, and you might get when they're in default or once per year on request or no more than once per year. Then there'd be the odd tenant that just put their foot down, and landlords would say, well, for this one, okay. And those days are just gone. Like every lease now, you're getting full financial reporting. There's definitely some restrictions around it, but there's just no grounds to say no, because it's like, well, look, we just went through this, situation where we all had to reflect on what was actually going on, and we absolutely needed that data. And the clients of mine that didn't have the data were left kind of wondering what was going on. And that's just obviously not a place that you can be if you've got to get reporting back to investors or lenders. So that's a place we're not going back to. And now I think, Mike, we can move to the next slide. Yeah, and the new paradigm, sort of where we're going here, Sean.
Yeah, I mean, again, obviously the death of retail, it's fun to say, and it's fun for, the news to talk about it. But I think the lessons have been learned out of this. It's not going away. It's changing. Retail is always the most quick and the most rapid to change. It's forced to change. Some of that is, based on consumer demand. A lot of it is just based on, new technology, new ingenuity, people trying new things, new companies coming out of nowhere. So ever evolving. I mean, you can't say that about, any other sector out there. Apartment buildings are kind of just apartment buildings, and the same with industrial. Not much change there. So, where I joke I should have been an apartment broker, I'm probably more valuable now to our clients than we've ever been. The specialty and specialization in retail is, far exceeds a lot of the other asset classes out there. I think where there's going to be some great, changes and places and things to look at is, in the grocery space, as well as in the pharmacy sector. Amazon's making a huge splash in grocery. Everybody's kind of aware of it now. We've been tracking it for a few years as they go out and try different sizes, different concepts, cashless and otherwise, cashierless, sorry. And now kind of making a big splash into the world. They have started with, the delivery, and then going into the bricks and mortar, where everybody else has gone the other way. Albertsons today, I just saw their online e-commerce was up 268% last year. So it's coming, it's transitioning. Again, there will be, a new world where people do continue to still order stuff, but you can't replace, and you won't replace bricks and mortar. The pharmacy thing, we always looked at Walgreens as kind of the gold standard in our world. They were the closest thing in retail real estate to a bond, and everybody tracked, where those cap rates were going, and that was the lead indicator for the world and how cap rates were shaking out in retail. There's going to be more changes there, not just from delivery of scripts, but also just who they want to be, what size they want to be. They're losing on their front end sales. They can't keep up with the cost of rent, the cost of employees, healthcare, and otherwise, to when the price of Coke is still kind of the price of Coke. So I think you'll see, where people went to flight to safety in those, and they thought they were always going to have kind of the best credit, the best, easiest and safest deal. There's going to be a tremendous shift there. Where there's a difference in, Starbucks sending you a letter and saying reduce your rent. We're working with, Walgreens and a lot of landlords on the Walgreens side that when you get that letter, it's real, and they're supporting it. They're telling you what they're doing in terms of sales volume. They're showing you their data. They're being transparent about it. And if you don't play ball, you're going to have a vacant store. Or they'll go dark with 7-8 years left on the lease, and would rather pay rent on a dark store, try to sublease it, than keep a store open that's not performing.
Yeah, there's definitely been some harsh realities for a lot, like just the general coupon clipper type properties that I think going into this, the last 10 years has been kind of it's going to print those percentages and you're good to go. And we had this little wake up where, okay, we've got to get creative to, make sure this tenant can hang on or do what's viable for the space. And to your point, that does seem like a very creative marketplace in the retail sector. You're seeing a lot of interesting uses come about, and a lot of interesting kind of smaller mom and pop retail users where people are realizing, I think, or the market's realizing, that there are a lot of positives to having that retail experience. Do you think that's one of the things that maybe comes out of COVID after so much online buying, or is that a pipe dream?
Yeah, I mean, all we talked about, 12 or 18 months ago was experiential retail, right? Everybody wanted the experience, and that exists. I mean, you're seeing it. The malls are trying to reinvent themselves, but malls are probably the hardest hit and will be the most challenging to come back out of this.
Mhm.
Retail is still good retail, or good retail is good retail. The corners, drive-throughs, all that stuff is still pretty safe and keep on clipping. I think again, it's just reinforces what's the market rent, what happened, what do I do if I get this thing back. More cities are putting restrictions on drive-throughs and where those can be or can open. You can't put a
Mhm.
drive-through on 15th and Ballard, for instance, anymore. So if you have one, that's gold, right? um,
Right.
and then we're just seeing the repurposing of it, whether it's that Sears is a client of ours and their real estate side of their business. I mean, some of those boxes were bad retail, the old Kmart's, and we sold a couple to U-Haul, for instance, right, where it's a self-storage play. Some of them are being torn down. The Seritage Redmond deal, which Seritage was a spinoff of Sears. I mean, that's going to be a 1.5 million square foot mixed use project. What used to be just an empty Sears. So there's a lot of changes. It's ever in flux, and I mean, we're in it because of the excitement, I guess.
Absolutely. And we're not this year is as we talked about before we even started. This is going to be a heavy deal flow year. So with that, thanks, Sean. That's all been an insightful discussion. Let's maybe open it up for some questions from the audience. If you have anything, just type it into the question box and we'll get to it. And it looks like we have one from earlier that I'll just jump on. How will a shift in the 1031 deferment laws impact the market, or will it? And if so, kind of when and how will that play out?
Yeah, obviously hot point of contention right now, that amongst kind of capital gains and some other things, along with, Washington state capital gains. I think, we hear this every 4 years or every change of administration, something's going to change. It's going to go away or otherwise. I think, our expectation is that, yes, there'll probably be some sort of shift. It's not going away. Could it be capped or limited, or number of times you can 1031? There's a lot of ways that it could potentially change. I don't think it remains open-ended like it is today. Would be our guess, but shutting it down completely would be pretty catastrophic to the transactional world of real estate, which is a massive generator of tax revenue, both on the federal side as well as on the state and local side. So I don't personally have a fear that it's going away. I know there's a number of our clients that have said they don't care to find out or wait and see. So we are selling a number of properties right now for folks that are throwing their hands up and getting out. My guess is they would have probably sold anyways in the next 12 or 24 months. So yeah.
Yeah, I mean, I would just respond by saying that we're not, I think we expect to see high deal volumes on just the threat of it. Probably, is it really going to happen? It seems kind of unlikely. We're all getting the 1031 exchange facilitator marketing pitch to get on board the lobby to preserve the 1031. But the reality is, it just doesn't seem like it's actually going to go away. But the key thing is, for sure, this year, there will be clients saying, okay, we got to move this asset and we're happy to pay the taxes. We were deferring them anyway. It's not like we weren't going to have to pay them. If we're going to move it, it's kind of probably going to be a lower tax rate. If we were going to do it, if our exit strategy was in like the next, 4 or 5 years, at least this administration's term anyway, okay, well, now's probably a time to go. They were probably going to move it anyway, based on that, whether or not a 1031 existed, or whether that code provision exists anymore. Another one was, what are the lenders doing in light of the COVID scare and the bounce back, and what's happening with interest rates? The time-honored tradition of the lender and financing question.
Yeah. Retail is obviously, it faces some headwinds from the lending standpoint. I think, this time last year we saw a lot of forbearance as it related to the lenders kind of proactively, as long as you were passing that through to your tenants, and giving, the kind of standard was roughly 3 months. I mean, you're still paying interest on that, but tacking it onto the back end, providing a little bit of relief, with some caveats that it had to be, conditioned to your tenants. So, I think there was more flexibility on extensions of deals, maturities to get through this. I do think, everybody was waiting for the big shoe to drop and there to be a, tremendous amount of opportunistic buys out there. That's just not happening. What we expect, looking forward is there's probably going to be a little more, struggles on the refinance side of things where lenders are going to require, additional capital to refinance. And that could break free some deals that may not have otherwise transacted, but it won't be just out of pain. And there's so much pent up capital on the side waiting for any sort of, downtick in pricing that, those true value opportunities won't really be there. The banking relationships, local lenders, rates for retail never dipped that low. They weren't like multifamily that were in the, low to mid twos or high twos. We kind of bottomed out at 3.5 roughly for the best stuff. That's probably up, 50 to 70 basis points since the bottom. Just more scrutiny around the rent roll credit and, those sorts of things.
Yeah, we just got a response from one of our audience members that is involved in banking that just said, yeah, we're pricing pretty much the same, but DSC and LTV limits have tightened up a bit for retail. And that makes sense. And I would expect to see some significant changes in how the security portions of the anchor tenant lease relationships go, whether it's corporate guarantees, increased reserves, security deposits. And I guess across the board, because we just watched what happened, and it was pretty clear that the landlords that had security deposits were just a little less concerned about what was going on versus those that had sort of nothing and were taking chances on tenants. So I think that might be a little bit of a shift as we go into refinancing assets and especially new leases where assets are encumbered by loans that require consent from their lender, which is pretty much all of them on anchor tenant leases and renewals. They're going to say, sure, we'll do it. That's great, but we got to have this now. And that'll be interesting to see how that plays out. We had another great question. How do you expect electric vehicles and self-driving vehicles impacting retail real estate?
I mean, it's actually been something we've been talking about for a long time. We host a client event every year, and I think the self-driving car was 2016 or 17. We had that as kind of the main deal. It's one of the things that I like best, about retail real estate. And what I'm most excited about is just the repurposing of these parking fields. When all of a sudden at some point, it's not going to happen out in the, in the suburbs or the tertiary markets anytime soon, but I think you'll start to see it closer in. We are seeing it, not just with scraping of shopping centers, but, putting a multifamily parcel on top of, a parking field just because you require less of it. So that's where I think you've got, a lot of these big shopping centers that are, massive acreage, and there's just a tremendous amount of opportunity. Federal Way Commons is a great example. Merlone bought that deal. I mean, the thing's on 60 acres of land. Like how, you just can't find that kind of stuff anymore, right? In areas as they continue to grow up, whether that's because of light rail or otherwise, and densify. I think there's going to be, some great projects that come out of that.
Yeah, in the core, when we're dealing with sort of skyscraper type properties where you have multiple floors of parking, we're definitely looking at how to reserve rights there, where in the past you might grant tenants large reserve blocks or whatever. We're reserving the right to come back in and repurpose those for whatever comes down the road, because there's just a general recognition that that parking space will just be, not being used as prevalently, and landlords need to retain the right to come back in and use it for a totally different purpose. So another great question, with the evolution in grocery, where do you see cap rates for grocery anchored centers going? Hard to put a lot of weight in the data over the last couple of years with the volume being non-existent.
Yeah, I mean, there's, obviously when the REITs are not buyers, that changes things as well. We're working on a couple. We just listed a 2-tenant grocery deal here that pricing is probably 25 to 50 bips lower than it would have been, the same time pre-COVID. Again, it's a little bit of the herd mentality, but also just where do people think the safest place is, and that's in grocery anchored. They outperformed every other retail sector or retail product type, I guess you could say, and that's where just the demand is going. So I think it's safe to say that we don't expect grocery anchored cap rates to come up. If anything, they're going down.
Yeah, I have nothing to add to that. That is a complete broker related question that I would never, that's delightful. And that's why we have Sean here today. Another great question. Are there areas of the Puget Sound, which you think have been more affected than others?
From a retail standpoint, I mean, obviously the downtown core was the most impacted and got decimated. There was something like 180 closures of store closures, restaurants and otherwise in downtown Seattle. I think that's going to take a long time to come back, not just because of people downtown and the other issues that it faces, but just the fact where rents were and the need to reset that rental rate and what those leases will look like going forward. A lot more percentage rent deals. There could be a lot of interesting opportunities for some built out restaurants that have shuttered, for new chefs and otherwise to come in and take the risk where they wouldn't have had the capital or otherwise prior to this. So definitely the urban cores hit the hardest.
Yeah, I'd agree with that shift. I'm just seeing more of that, of the percentage rent stuff, where we didn't see that and as frequently unless you're in a mall setting. Obviously all the Kemper stuff is percentage rent based and all that, but I think we're just going to see an increase in that as there's a realization that if you want those spaces to perform, you're going to have a little more skin in the game, and there's going to be more of a willingness to let that happen and take that risk as the impacts kind of drag on to the core. That's just a wild guess, but it just seems really likely. Sort of our last question here. Do you feel inflation will finally start taking place given the additional deficit the government has taken on? If so, do you think cap rates after 8+ years will finally start to rise?
I'm no crystal ball or economist, although I studied econ. I was a C student anyway, so that's why I'm a real estate broker. I mean, I think it's the inflation in our world, I don't think directly just ties immediately to cap rates. I think what it does is going to impact construction. It's going to raise rents. It's going to potentially get people to seek out real estate and hard goods, commodities like that. So I don't know if I have an answer that's any smarter than anybody else could say on the phone, but I think again, it's just so damn hard to build. There's so little product coming online. I don't think we've been saying that inflation's been coming or is coming for the last 20 something years, and don't know. Buy some Bitcoin maybe though.
Some Dogecoin, yeah. Well, this has been insightful as always. I'd point out there that like I said, over the years, done a lot of work with Sean and his team at Capital Pacific. And so if you've got issues or further questions, by all means, reach out to Sean. We remain available as real estate and business counsel, and we thank you for attending today. We do these monthly, so look out for an invite to the June webinar. And if you have colleagues or friends or clients that are interested in watching this, it's recorded. It'll be on our YouTube channel, and you could spread it along and give them some insight as well. Thank you very much again, Sean. It's been great to have you, and thank you all for coming.
Thanks.